As inflation continues to show signs of cooling, Goldman Sachs economists are penciling in the Fed's first interest rate cut in June of next year as it looks to normalize the funds rate. Yahoo Finance's Josh Schafer has the details on this call. So talk about this base case here.
Yeah, Rochelle. So what I'm standing next to right now is that base case call from Goldman. And you can see what they're saying here is essentially they think the first rate cut for the Fed is going to come in the second quarter of next year. So when you're looking at this graph here, you can see Goldman's call is in purple. What's in orange, which is interesting to point out, is actually what the market's currently pricing. So the market is currently pricing a cut at around the same time as Goldman, but they see cuts coming steeper and quicker than Goldman Sachs currently sees it. Goldman Sachs has viewed themselves as relatively hawkish in terms of Fed policy, which is why people have been very interested in this call out today. Now, I want to take a look at the different scenarios that Goldman Sachs has pointed out that could happen and how that could sort of drive interest rates. So they see 4 different scenarios that they highlight here. The baseline scenario is in blue. That is driven by inflation, and that's the key thing to understand here is the different things driving these scenarios. Then there is the red scenario. This would be driven by a full recession, but we've been talking a lot over the last couple of weeks. Economists see less and less likelihood of a recession. In fact, Goldman Sachs sees about a 20% chance of a recession in the next 12 months. So they don't see this big drop in rate cuts coming quick and fast next year anymore. They also don't see growth completely going negative or the threat of growth going negative being abundant next year. That's your orange line. So what they see now is cuts coming next year, but not coming at necessarily a rapid pace. They see the reason the Fed would be cutting is because inflation is starting to come into proper balance and headed toward the right direction. So then when you take a look at that inflation chart, you can see that starting to play out a little bit. We're still pretty far away from the 2% the Fed wants, which would be a little bit closer to down here. But core PCE, which the Fed closely follows, has been headed down in that direction. And essentially what Goldman Sachs is arguing overall here is that will be the driver for what happens with rate cuts, not a recession, not the economy fully slowing down, but rather just the Fed winning that battle against inflation and starting to feel very confident about the fact that it's in a good place in the second quarter of next year, come May or June. That will drive the first Fed rate cut that we see after this long rate hike cycle.
We'll certainly have to see. I mean, as we saw with the regional banking crisis, anything could really throw a spanner in the works. But I know you'll be tracking all of that for us. Thanks so much, Josh.